If you were born anywhere between 1950 and 1968, I need you to stop what you're doing and pay attention to this video, because the IRS and retirement account rules that apply specifically to your birth year range have changed more in the last 18 months than they have in the previous decade. And I'm not saying that to alarm you. I'm saying it because the specific changes I'm about to walk through cut in two very different directions. Some of them work in your favor in a big way: bigger deductions, higher contribution limits, new tax strategies that weren't available before. And some of them are creating penalties, tax bills, and Medicare premium surcharges that are hitting people this fall completely by surprise, specifically because they didn't know the rules had shifted. Here's what's actually new. There's a $6,000 senior bonus deduction available right now that most people in this birth year range are either missing entirely or claiming wrong, which creates its own set of problems. There are RMD rules that are splitting this group down the middle based on exact birth year, and getting which side of that line you're on wrong is a 25% penalty. There's a brand new super catch-up contribution window specifically for people born between 1963 and 1966 that most people in that window have no idea is available to them. And there are IRMAA Medicare premium surcharges that are being triggered by retirement income decisions people made 2 years ago, showing up now on Medicare bills with no warning. So today's video is going to do something a little different from what most financial channels do. Instead of just listing rule changes, I'm going to walk through what each rule means specifically based on your birth year. Because someone born in 1950 is facing a completely different set of priorities than someone born in 1968, even though both of them are in this video's target range. And a generic "here's what changed" breakdown doesn't help you if it doesn't tell you what changed for you. I'm Marcus Grave. Get a pen. The birth year specific details in this video are worth writing down. Subscribe before we get started. When IRS and retirement rules shift, this channel is where those shifts get translated into plain language, before the deadline, not after. Let's get into it. Before I get into the specific rules, I want to give you the birth year map, because the single biggest source of confusion in retirement planning right now is people applying the wrong rule to their situation because they don't know exactly which side of a specific age threshold they fall on. Here's how the 1950-1968 range breaks down for 2026's most important rules. If you were born between 1950 and 1952, you are 73 to 76 in 2026. You are fully in RMD territory, you've already had your first required minimum distribution, and you're in the phase where the annual distribution amount grows each year as your life expectancy factor decreases. The senior bonus deduction applies to you, and the interaction between your RMDs and that deduction's income phase-out is the most important planning issue for your specific situation right now. If you were born in 1953, you turn 73 in 2026. This is your first RMD year. The decisions you make in this specific year, whether to take your first RMD before December 31st or delay it to April 1st of 2027, and whether that delay makes sense for you, have consequences that will echo through your tax bills for years. I'm going to spend significant time on this specific birth year. If you were born between 1954 and 1959, you are 67 to 72 in 2026. You are not yet in RMD territory. Your first RMD year is coming, but it hasn't arrived. This is actually the most strategically important window in retirement planning, and most people in it are not using it. The window between now and your first RMD year is when Roth conversions make the most sense, when certain income strategies are most effective, and when the decisions you make will determine your tax situation in RMD years. I'll explain why. If you were born between 1960 and 1962, you are 64 to 66 in 2026. You are approaching Medicare eligibility and approaching the window for Social Security claiming decisions. The senior bonus deduction applies once you turn 65, but you're not there yet if you were born in 1961 or 1962. And here's something specific to this group. If you were born in 1960 or later, your RMD age is not 73, it's 75. That's a 2-year difference that changes your planning window significantly. If you were born between 1963 and 1966, this is the super catch-up window. If you're still contributing to a workplace retirement plan, a 401k, 403b, or similar, you have access to a special catch-up contribution limit that is higher than the standard over 50 catch-up. I'll walk through the exact numbers and why this group in particular should be maximizing this right now. If you were born between 1967 and 1968, you are 58 to 59 in 2026. The super catch-up window is 1 to 2 years away. Your Social Security full retirement age is 67, further out than earlier birth years. Your focus right now is building the foundation for the decisions that will define your retirement income. Roth conversions, catch-up contributions, and Social Security timing strategy are all relevant now, even though none of the key ages have been hit yet. Hold that map in your head as we go through each rule. I'm going to keep connecting each change back to the birth years it affects most directly. All right, let's start with the rule change that's getting the most coverage and generating the most confusion. The One Big Beautiful Bill Act, signed into law in 2025, created what the IRS is now calling the Senior Bonus Deduction. For tax years 2025 through 2028, if you are 65 or older by the last day of the tax year, you can claim an additional $6,000 deduction on your federal tax return. Married couples where both spouses are 65 or older can claim $12,000 combined. Now here's where I need to slow down, because the misinformation floating around about this deduction is actively costing people money. What it actually is: a deduction. That means it reduces your taxable income by $6,000. It stacks on top of your regular standard deduction and on top of the additional standard deduction that seniors already received before this law passed. If you take the standard deduction, you can still claim it. If you itemize, you can still claim it. It doesn't require a special form or a separate application. It's part of your regular return. What it is not a tax credit. A credit would reduce your tax dollar for dollar. A deduction reduces the income that gets taxed, which is meaningful but different. It is also not, and I want to be very clear here, a provision that makes Social Security benefits tax-free. I know that's what a lot of people heard. The headlines saying Social Security is now tax-free were wrong, and people who filed their 2025 returns based on that assumption may have an unpleasant surprise coming. Social Security is still federally taxable, up to 85% of your benefits, based on your combined income, your adjusted gross income plus any non-taxable interest, plus half of your annual Social Security. The $6,000 deduction can reduce your taxable income enough that fewer of your Social Security benefits end up in taxable territory, but it doesn't change the combined income formula itself. And for many people in this birth year range, especially those with pensions, IRA distributions, and Social Security all landing in the same year, the math doesn't zero out just because of the deduction. Who in the 1950-1968 range does this help most? If you were born between 1950 and 1960 and are already 65 or older, the deduction is available to you right now for your 2025 return. For people born in 1961, you'll be 65 by December 31st, 2026, so the deduction applies to your 2026 return filed in 2027. Born in 1962, you'll hit 65 in 2027. Born in 1963 or later, check your specific 65th birthday against the December 31st deadline for each tax year. The phase out. This is where people are making expensive mistakes. The $6,000 deduction is not available in full at all income levels. It reduces by $60 for every $1,000 of modified adjusted gross income above $75,000 for a single filer, or above $150,000 for a married couple filing jointly. By $175,000 for a single filer, or $250,000 for a married couple, the deduction is completely gone. Here's why this matters so much for the 1950-1968 birth year range specifically. Many people in this group are now drawing from multiple income sources simultaneously: Social Security, a pension, IRA distributions, and sometimes part-time work. Every dollar of additional income you pull in the same year can push you closer to or over the $75,000 threshold where the deduction starts shrinking. So if you were planning a large IRA distribution this fall, maybe for a home repair, a gift to a child, a vacation, and your income is anywhere near $75,000 without that distribution, I want you to pause and run the math before you take that money. Every $1,000 you pull over the threshold costs you $60 of this deduction. Pulling $20,000 over the threshold in 1 year costs you $1,200 of the deduction. That's real money from a deduction you've earned just by being the age you are. The interaction with RMDs. Pay very close attention here. For people born between 1950 and 1953, this is the most important intersection in your entire 2026 tax picture. Your RMD is not optional. The IRS requires that withdrawal whether you need the money or not. And your RMD counts toward your AGI, which means it counts toward the modified adjusted gross income that determines how much of your $6,000 senior bonus deduction you get to keep. For some people, the RMD itself pushes them over the $75,000 threshold, partially or fully eliminating the deduction they would have received if they could control the timing of their withdrawals. You can't eliminate the RMD, but you can use strategies that reduce the taxable income impact of the RMD, which I'll cover in Part 4. The Qualified Charitable Distribution Strategy in particular was specifically designed for exactly this situation. Okay, required minimum distributions. This is the rule where getting your birth year wrong is the most expensive mistake you can make. Here's the critical split. Born before 1960, your RMD age is 73. If you were born between 1950 and 1952, you are already past your first RMD year and you're taking annual distributions. If you were born in 1953, you turn 73 in 2026. This is your first RMD year, and the decisions you make this year specifically matter enormously. Born in 1960 or later, your RMD age is 75, not 73. This is a 2-year difference that a lot of people in the 1960-1968 range don't know about. If you were born in 1960 and assumed your RMDs start at 73, you have 2 extra years of tax-deferred growth and 2 extra years to do Roth conversions, income planning, and other strategies before the RMD clock starts. That's not a small thing. For people born in 1953, your first RMD year in 2026. Let me walk through this carefully because the first RMD year has a specific decision point that carries real consequences. Your first required distribution from a traditional IRA or 401k can be taken either by December 31st, 2026, the standard deadline, or you can delay it until April 1st, 2027, the special first-year grace period. Here's the thing about that grace period that most people don't understand. If you delay your first RMD to April 1st, 2027, you still have to take your second RMD by December 31st, 2027, which means 2 full RMD amounts land in the same calendar year. Both count as taxable income in 2027. 2 large retirement distributions in the same year can push you into a higher tax bracket, increase the taxable portion of your Social Security benefits, and trigger IRMAA Medicare premium surcharges, which I'll get to in a moment. For most people born in 1953, taking the first RMD in 2026 rather than delaying it is the better move. It spreads the taxable income across 2 years rather than doubling it in 1. But the right answer depends on your specific income situation. So if you're unsure, run the numbers before December 31st. The forgotten account problem. Here's something that's sending people straight into penalties right now. A lot of people in the 1950-1968 range had multiple jobs across their careers, and each of those jobs may have had its own 401k. Some of those accounts got rolled into IRAs, some didn't. An old 401k sitting at a former employer's plan administrator, maybe from a job you left 20 years ago, is still subject to RMD rules. The IRS doesn't care that you forgot it existed. If you're in your RMD years, that account needs its own distribution. Go through your entire work history and make sure every retirement account you've ever had is accounted for. This is the section I specifically want people born between 1963 and 1966 to hear, because this benefit was created specifically for your birth year window, and the majority of people eligible for it have never heard it exists. Under Secure 2.0, a new catch-up contribution rule called the Super Catch-up applies to people ages 60, 61, 62, and 63 who are contributing to a workplace retirement plan, a 401k, 403b, or similar employer plan. If you are in that age range during 2026, your catch-up contribution limit is not the standard $8,000 that applies to people 50 to 59 and 64 plus. It's higher. Who does this apply to in the 1950-1968 range? If you were born in 1963, you turn 63 in 2026. You're in the super catch-up window this year. If you were born in 1964, you turn 62 in the window. If you were born in 1965, you turn 61 in the window. If you were born in 1966, you turn 60 in the window for the first time. If you were born in 1967, you turn 59, not yet in the window, but next year. Here's why this matters so much for this specific group. People born between 1963 and 1966 are in what financial planners call the retirement red zone, close enough to retirement that every additional dollar going into a tax-advantaged retirement account has compounding time that's shorter, but close enough to retirement that catching up on contributions can meaningfully change the final balance. The super catch-up is a use it or lose it benefit. You can only access it during the specific years you're in the 60 to 63 age window. Once you turn 64, you drop back to the standard catch-up limit. So if you're in this window right now and you're not maximizing your workplace plan contributions, you're leaving a tax-advantaged opportunity on the table that will not come back. If you have the cash flow to do it, or if you can restructure your spending to free up the cash flow, maximizing your 401k contribution this year, including the super catch-up, is one of the highest value financial moves available specifically to this birth year group. Let me talk about something that is landing on people's mailboxes right now and catching them completely off guard. IRMAA, the Income-Related Monthly Adjustment Amount. Here's what IRMAA is. Medicare Part B and Part D premiums are not the same for everyone. For 2026, the standard Part B premium is $185 per month. But if your income exceeds certain thresholds, you pay more, significantly more, on top of the standard premium. This additional amount is IRMAA. It comes in 5 tiers based on your income, and the highest tier can add over $400 per month to your Medicare costs, on top of the standard premium. Here's what makes IRMAA particularly frustrating. The income Medicare uses to calculate your IRMAA in 2026 is not your current income. It's your income from 2024, 2 years ago. This is called the 2-year look back, which means a financial decision you made in 2024, a large Roth conversion, a home sale, a big IRA withdrawal, an unusually good year of investment gains, could be showing up as a Medicare premium surcharge right now in 2026 with no direct connection you'd naturally make between the two. For people born in the 1950-1968 range, the most common IRMAA triggers I see are exactly the income events that become more common as retirement approaches. Roth conversions done in a large lump sum before reaching RMD age, large IRA distributions to cover a major expense, sale of a vacation home or investment property, a severance package or deferred compensation payout in a high-income year. Each of these can push the 2 years prior income above an IRMAA threshold in a way that creates a meaningful Medicare premium surcharge you weren't expecting. The appeal option. Most people don't know this exists. If your income drops significantly between the year Medicare is looking at and your current situation, because you retired, because of a divorce, because of a death in the family, because of a one-time income event that won't recur, you can file a life-changing event appeal with Social Security to have your IRMAA recalculated based on more recent income. The official form is SSA 44. If your situation qualifies and retirement is one of the recognized qualifying life-changing events, this appeal can eliminate or significantly reduce your IRMAA surcharge. For people in this birth year range who recently retired and are now seeing elevated Medicare premiums based on their last working year's income, this appeal is worth filing. You apply through SSA, not Medicare directly, using Form SSA 44. The process takes several weeks, and if approved, your premiums are adjusted going forward. Planning ahead for IRMAA. For people born between 1957 and 1966 who are approaching Medicare eligibility in the next few years, this look-back rule means that what you do with your income in the 2 years before you go on Medicare directly determines your initial Medicare premium. If you're doing large Roth conversions, taking major retirement distributions, or expecting a high income year, model what those income events do to your Medicare premiums 2 years later, before you execute them, not after. Spreading large income events across 2 years instead of concentrating them in one is one of the most effective and overlooked strategies for managing IRMAA at the point of Medicare entry. All right, this section is specifically for people born between 1954 and 1959. You are 67 to 72 in 2026. You're not yet in RMD territory. Your first required distribution is still years away. And this window, the time between now and your first RMD, is one of the most strategically valuable periods in your entire financial life. Most people in it are not using it intentionally. Here's why it matters. Before your RMDs start, you have significant control over how much taxable income you recognize each year. Your Social Security may be partially or fully untaxed, depending on your total income. Your tax bracket may be lower than it's been in decades, and lower than it will be once your RMDs start forcing taxable withdrawals every year. This is the window when moving money from a traditional IRA to a Roth IRA, a Roth conversion, makes the most strategic sense for many people. When you convert traditional IRA money to Roth, you pay taxes on the converted amount at your current rate. The converted money then grows tax-free and future withdrawals are tax-free. Most importantly, Roth IRAs don't have RMDs during the original owner's lifetime, which means converting now reduces the balance that will be forced out of your traditional accounts as taxable RMDs starting at 73 or 75. The question isn't whether Roth conversions are valuable. For most people in this pre-RMD window, they are. The question is how much to convert each year without triggering the IRMAA thresholds, pushing into a higher tax bracket, or reducing the $6,000 senior bonus deduction if it applies to you. The answer is almost always convert up to, but not over, your next bracket threshold or IRMAA threshold, whichever comes first. Run the numbers for your specific income before converting, not after. One more thing for this group. If you haven't already, consider delaying Social Security if you haven't claimed yet. Every year you delay past your full retirement age, up to age 70, your benefit grows by 8%. For people in the 1954-1959 range who are 67 to 72, you may still have the option to delay and increase your guaranteed lifetime income. That's a guaranteed 8% return on your benefit for each year of delay, which is hard to beat in any other investment environment. Let me close with a birth year specific action list, what the single most important thing is for each group in this video right now. Born 1950, 1952. Your most important action right now is verifying that your RMDs are being calculated correctly each year using current IRS life expectancy tables, and checking whether any part of your RMD can be satisfied through a QCD if you're charitably inclined. Every dollar of RMD converted to a QCD is a dollar that doesn't push your combined income higher and doesn't eat into your $6,000 senior bonus deduction. Born 1953. Your most important action is deciding right now whether to take your first RMD before December 31st, 2026, or delay it to April 1st, 2027, and running the math on how doubling up in 2027 affects your bracket, Social Security taxes, and Medicare premiums. For most people, taking it in 2026 is better. Born 1954, 1959. Your most important action is beginning a deliberate Roth conversion strategy, converting as much as you can up to the next bracket threshold each year without triggering IRMAA or losing the senior bonus deduction, so that your future RMD obligations are smaller and your retirement income is more tax efficient. Born 1960, 1962. Your most important action is understanding that your RMD age is 75, not 73, which extends your Roth conversion and planning window significantly, and preparing for Medicare enrollment if you're approaching 65. Born 1963, 1966. Your most important action is maximizing your super catch-up contributions to your workplace plan right now, while you're in the 60 to 63 age window. This window closes permanently once you turn 64. Born 1967, 1968. Your most important action is building awareness of the key ages coming up for you. The super catch-up window starting at 60, the IRMAA look back 2 years before Medicare entry, and the Roth conversion window that starts now and runs until your first RMD. The decisions you make in the next 5 years will define your retirement income. The IRS doesn't send you a letter when the rules that apply to your birth year change. The retirement system doesn't flag your account when a new catch-up limit becomes available, or when your income from 2 years ago is about to appear as a Medicare surcharge, or when a deduction you could have used is about to phase out because of a withdrawal you didn't have to take. These rules change constantly. They split by birth year in ways that feel arbitrary until you understand the underlying logic. And the gap between someone who knows them and someone who doesn't isn't just a matter of tax efficiency. It's thousands of dollars per year, every year, in retirement income that's either protected or unnecessarily handed to the IRS. The birth year specific actions I laid out at the end of this video are where I'd start if I were in your situation. Pick the one that matches your birth year. Do that thing this fall, before year end, when the deadlines that matter most for 2026 are still in front of you, rather than behind you. If you know someone born between 1950 and 1968 who is managing their own retirement finances without this information, send them this video. The fall tax planning window closes at year end and doesn't come back. Subscribe to this channel. I break down every rule change that affects retirement and Social Security as soon as it happens, in plain language, for the people it actually affects. I'll see you in the next one.